In the 1600s, the Dutch East India Company used hundreds of ships to trade gold, porcelain, spices, and silk around the world. But running this massive business was incredibly expensive. To fund their risky trips, the company turned to regular citizens, everyday people who could invest money to support the journey in exchange for a share of the ship's profits. This strategy allowed the company to launch even bigger voyages, increasing profits for both themselves and their smart investors. By selling these shares in coffee houses in busy shipping ports across Europe, the Dutch East India Company accidentally invented the world's very first stock market. Since then, companies have been raising money from willing investors to fund all kinds of businesses. Today, the stock market has college courses, entire careers, and even dedicated TV networks focused on understanding it. But the modern stock market is much more complicated than its original version. So how do companies and investors use the market today? Let's imagine a new coffee company that decides to launch on the market. First, the business will pitch itself to big institutional investors. If they think the company is a good idea, they get the first chance to invest, and then they sponsor the company's initial public offering, or IPO. This launches the company onto the official public market, where any business or everyday person who thinks the company can make money can buy a stock. Buying stocks makes those investors partial owners of the business. Their money helps the company grow, and as it becomes more successful, more buyers see the potential and start buying stocks too. As demand for those stocks goes up, so does their price, making it more expensive for new buyers and increasing the value of the stocks people already own. For the company, this rising interest helps fund new projects and raises its overall market value by showing how many people believe in their idea. However, if a company starts to look less profitable, the exact opposite can happen. If investors worry their stock value is about to drop, they will sell their stocks to lock in a profit before the company loses more value. As stocks are sold and demand goes down, the stock price falls, and with it, the company's total market value drops. This can leave investors with big losses unless the company starts to look profitable again. This seesaw of supply and demand is shaped by many factors. Companies are always affected by market forces like the changing cost of ingredients, new manufacturing technology, and rising wages. Investors might worry about a change in company leadership, bad publicity, or bigger things like new laws and trade rules. And of course, plenty of investors are simply ready to sell their profitable stocks to spend money on personal goals. All these things create daily noise in the market, which can make companies look more or less successful than they really are. In the stock market, appearing to lose value often leads to losing investors, which causes the company to lose actual value. Human confidence in the market has the power to trigger everything from economic booms to financial crashes. This unpredictable human element is why most experts recommend safe, long-term investing over trying to make quick cash. Even so, professionals are constantly building new tools to try and improve their chances of success in this highly unpredictable system. But the stock market is no longer just for the wealthy elite. With the rise of the internet, everyday investors can buy stocks in almost the exact same way a massive bank would. As more people educate themselves about this complex system, they too can trade stocks, support the businesses they believe in, and reach their financial goals. The first step is simply getting invested.